credit risk, the risk that a borrower may fail to repay the loan as promised. And whenever a borrower defaults, the bank doesn't just lose sleep, it loses money. So instead of guessing who might default, modern risk management uses numbers and measurable quantities to estimate losses scientifically. This is where quantitative measures of credit risk come into the picture. The first thing we ask is simple. What are the chances this borrower will default? This is called the probability of default, or PD. PD tells us the likelihood that a borrower fails to meet their obligation within a given time period, usually 1 year. For example, if the PD is 4%, it means that out of 100 similar borrowers, about 4 might default. But remember, PD only tells us the chance of default, not how much money we lose. Sometimes borrowers miss payments temporarily and recover later, so PD is just the likelihood, not the damage. Now suppose default actually happens. The next logical question becomes, how much money will we lose? That's where loss given default, or LGD, comes in. LGD measures the severity of the loss after default. If a loan is unsecured and nothing can be recovered, LGD could be close to 100%, meaning total loss. But if the loan is backed by collateral like property or machinery, the bank can recover some money, and LGD might drop to 30% or 40%. So LGD tells us the fraction of exposure that is not recovered. In simple words, PD is the chance of falling, while LGD is how badly you get hurt after the fall. Next, we think about the size of the loan itself. Even if default happens and losses are high, it matters whether the exposure was small or huge. This is captured by exposure at default, or EAD. EAD is simply the amount outstanding when the borrower defaults. For a term loan, it may be the remaining balance. But for credit cards or credit lines, customers might draw more money just before default, increasing exposure suddenly. So EAD tells us how much money is actually at risk at that moment. Now here's the interesting part. Banks combine all three of these measures to calculate something called expected loss. This represents the average loss the bank expects over time from its lending activities. The formula is very intuitive. Expected loss equals PD multiplied by LGD multiplied by EAD. In other words, chance of default times loss severity times exposure amount. But we're not done yet, because time also matters. The longer the loan exists, the higher the uncertainty. A 1-year loan has less risk than a 5-year loan simply because there's more time for things to go wrong. As time increases, the probability of default rises. Exposure may change as borrowers draw or repay money. Even collateral values can fluctuate, affecting LGD. So credit risk is always measured over a specific time horizon. Finally, when banks manage many loans together in a portfolio, they also consider correlations. If many borrowers default at the same time during a recession, losses can spike. So portfolio risk is not just the sum of individual risks. Understanding how these risks move together is crucial.